everybody. This is Jake Senziano, host of the Wheelbarrow Profits podcast, here with my co-host, the multifamily mentor, the coach, the chef, the father, six, the best-selling author, the G-Daddy, Gino Wheelbarrow. Gino, how's it going?
Mr. Stenziano, Yaki Boom Boom. Doing good, bro. How are you?
Always making it happen, big man. This is a big deal. This is a special edition of the Wheelbarrow Profits podcast with just Jake and the G-Daddy. And today we're going to detail our journey to 1,000 units, a pizza guy and a drug rep's tale. All right, G-Dad, we're going Lord of the Rings on the folks today. So I think we got to take it back to the spring of 2011. I was leaving New York. I said, peace and love. I am an economic deserter. I am getting out of here, right? I'm looking at what's going on, and I'm saying this is too much for me. So before I left, I came in and I saw you had a really good relationship with Marco, your brother. We used to hang out at the Yankee games. And I always saw this guy in the back with his arms crossed and had limited actual sort of discussions with you. Marco comes back, says, I'm leaving, go to Knoxville, interested in potentially getting into real estate. And you came out and did what?
Came out and told you, hey, dude, I'm trying to buy stuff up here.
Yeah.
Nothing buying up here. There's nothing going on. I can't find any deals up here. And that's what everyone says. So I had my limiting beliefs. I was buying in Rochester, New York. I said, hey, let me test Knoxville. When you get down to Knoxville, give me a call. Let me know what you're doing, and let's get together. That's
a long shot, though. You mean, because we pulled out the laptop and actually started looking at deals. It was on, it was like LoopNet or one of these local sites, and it was like, I remember you saying, "What these things are like, 30,000 a unit." This was 2011. You didn't have anything really trading in 08. You didn't have anything. Well, end of 08, 09, 2010, nothing was really moving. The banks weren't really lending, so everything was kind of stagnant. And then, things were starting to change a little bit in the spring of 2011. You're looking at this stuff, and I remember you seemed like you were drooling over it at the time.
Well, you were looking at industrial. I remember you looking at strip malls and all that. I'm like, dude, we have to stay away from that because I had bought a strip mall 5 years earlier, and it was just not the cycle to buy. It was a cycle to buy them if you're buying them on actuals and then filling them up going forward. But it just wasn't the place for me to be. I saw the internet because I was trying to sell stuff on Amazon 7 years ago, and I saw the internet just starting to take over these big boxes, these big box stores. So I said, let's look at multifamily. And I wanted multifamily for two reasons. I didn't want another job. And I wanted to scale up the business. So I knew that 7 years ago, saying this is what we need to do. And we're looking at these numbers. I was like, wow. I mean, but remember, rental rates back 7, 8 years ago were really a lot lower also. Yep. So rents for a two-bedroom that we're looking at were $450 a month. So for a $30,000 per door, unit, it was justified. Fast forward till now, those rents we're collecting 700 plus rubs. So rents have exploded as cap rates have come down and valuations have increased. So you just have to take a look at the cycle, what part of the cycle you are. And I was excited because I'm like, dude, I can see this working. I can see this, we can find something down there. And I was just excited. I was excited for the possibility of finding something down there. I said to my brother, if you want to jump on board, be great. And he was a little hesitant. He was more in the mindset of, no, we need to take care of the restaurant. And I'm like, we've been here for so long. The recession is hurting us because the recession doesn't just hurt real estate, which is a huge component of the economy. When construction people aren't coming out to eat, when real estate brokers aren't coming out to eat, you're taking a big hit in your business. So I just saw the writing on the wall. Thank God I did. And that's how it started.
Well, and that's a real thing because I remember I moved to the Westchester area in 2006-ish, and it was just booming. 06, 07, everyone's going out to eat. You couldn't even get into a restaurant. Mm-hmm. And then after the crash, it still hasn't rebounded yet. I mean, it just is not the same as it was going to. And I don't know if it ever will get back to that. It was just an interesting phenomenon. But, I had Dr. Neshi, one of these doctors that I was calling on, who was kind of telling me, look, you got to go buy a duplex. That's the first move that I did when I got out of medical school. You rent out half of it, house hack. And then at the time I was like, well, I'm going to start a gym. So that's why Gino said I was looking at industrial, because I had one side telling me, hey, do this multifamily kind of thing. And I thought I was going to actually start a gym, and I wanted to buy a building. So that's where I was kind of getting torn. And these conversations actually helped focus me on that passive income approach and, reading The Richest Man in Babylon and learning about, assets versus liabilities. So that's going back to the spring of 2011, jump ahead to that summer of 2011. We started underwriting deals. I moved down to Knoxville. I was down here by myself. And then, we had guys that are essentially laughing at us. You want to dive into that a little bit?
Well, it's funny. I remember looking at these deals, and y'all ain't going to do any business down here. We kept getting that from a lot of brokers. And let's be clear, everybody. When you're looking at a multifamily property, be sure you tell the broker what you're looking for. We had a lot of brokers sending us a student housing. We didn't want student housing. We had a lot of brokers sending us stuff that was industrial. We didn't want that stuff. We weren't clear enough. They wanted us to sign exclusivities. We didn't want to do that. And we were getting pushed around. And a lot of newbies are going to get pushed around. And that's one of the things with the Jake and Gino community. A lot of our community members ask us questions, when they're first starting to buy their first deal. Did this happen to you? Did that happen to you? It all happened to us, and it's all a learning curve. And I was actually fortunate to be coaching and being guided by my mentor on our first couple of deals, would help me out tremendously. And I remember that, sign an exclusive. I mean, this guy made us sign an exclusive, and 3 days later, he was trying to, and 3 days later, he brings me a deal, the Normandy Chateau. This was not a chateau. This was not a chateau. You're gonna hear the plaza, you're gonna hear the chateau, you're gonna hear the villa. Dude, these are not villas, and they're not chateaus. And I looked at him, and go on LoopNet. The deal's been on LoopNet, sitting there forever. And he's like, "Yeah, I got this deal." I'm like, "Dude, someone sent this to me 3 days ago." And he, became very belligerent, actually. And that's when he said, "You ain't going to do business." And I said, "Hold on a second." I said, "This is not an exclusive offer. If you got something exclusive, you bring it to me. I will pay you. You will get paid from us. But you just can't want an exclusive from us and send the stuff that's online and say you're being creative here. That's not how real estate works." And unfortunately, never did business with the guy again. I haven't seen him in years. I'd love to tell him we've got 1,000 units. He lost out on a ton of business, but you know what? You just let it go, as the cartoon says, let it go, let it go.
This was the number one, the self-proclaimed number one broker in East Tennessee, though.
I remember that, dude. Everyone proclaims themselves, but we moved on, and we didn't let it harm us. Jake goes out and goes and buys a house around that time because his wife comes down. He needs a place to live, and we put everything on hold for a couple of months after that. But this
was going into the spring of 2012, right?
Yep. I still had that burning desire because I still wanted to buy something because I needed to escape what I was doing. I needed to know that the model worked. And, the average person, if they didn't have that big enough why, this was 10 years earlier and the economy was doing great and I was happy with the job, I probably would have said, "You know what, Jake, let's revisit this in a couple of years." But I was just steadfast. I wanted to buy something down there because I couldn't find anything in New York. Would I have loved to buy something in my backyard? It would have been awesome, dude, because I would have been able to manage it myself and, take care of it, but I just couldn't. So spring of 2012, he buys the house, takes a couple of months off. I remember I was sitting in my basement. I'm like, darn, man, he went and bought a house. So
that was all my money.
I know. I couldn't disagree. I couldn't argue with you because I probably would have done the same thing. But for all of you out there, I think one of the action steps.
I didn't buy the duplex either.
Yeah, one of the learning lessons. It's one of those things where if you have the decision in life to make, whether you're going to buy a liability or continue to grow your assets, please just take a pause and know that the house can be there in 2 to 3 years. Just know that. Know you can buy a house in 2 to 3 years. I would rent and use all that money for a down payment to buy an asset because that asset will pay for your rent. And then all of a sudden, when you become financially free, the light bulb is going to go off and you're like, wow, I've got time to work on myself. I've got time to do this. Because going on vacation and creating opportunities and creating experiences is so much more powerful than saying you own a house. Trust me. Now that I look back, I made those mistakes too. I built houses in New York. I overspent on building houses. I think the first thing I think everyone on this call should do is just reassess where they are. If you're at that point where you're going to be looking into buying a house, buy a duplex, buy an FHA, use an FHA loan, try to get into something where you can house hack and get that 1 or 2 tenants that are helping you pay the mortgage. And then you're in the game. And then I will guarantee you, once you buy your first deal, you'll be hooked. You'll be like, this real estate thing is great. And if it's not, no harm, no foul, you either continue to live there rent free or you sell the place.
It was interesting because now we started in spring of 2011, and now we're getting into the fall of 2012. So we're talking a year and a half. Didn't even know each other that well before I left, but for a year and a half, we literally were masterminding over the phone, creating a relationship and analyzing deals like crazy. I mean, it was just bizarre that it actually came to fruition because, again, I was really close with Marco, and then all of a sudden Gino and I just start taking calls together, reviewing deals, emailing back and forth, and we're into it for a year and a half with no results. And that's why so many times I say the best thing that the two of us did is we didn't quit, because okay, now the house was great. We're in there. It's summertime. I'm like, okay, now what? So I start getting the bug again, and we start looking at deals. So it was a short pause. It wasn't like, oh, we just totally quit. But you go through a life event like that, you definitely take a quick time out. And then this little thing, Courtyard Cottages, comes along, and the broker seems receptive. The numbers seem to actually work, but it came with a whole host of other problems. And that was our our first deal that we got under contract, but that was in the late fall of 2012. Gino, you want to talk a little bit about that experience?
The deal was on LoopNet, sat there for a couple of years. We found a lot of deals on LoopNet, and you can still find deals on LoopNet, that ones that flounder. $750,000 for 20 units. It probably was worth that if they had a little love into it, if they had, taken care of it a little bit. We were desperate. It had owner financing on it. I loved it because it was a Fixer J special. For any of you who don't know who Fixer J DeSima is, just Google his name. He's written some really great books about owner financing, how about creating paper, and about actually once you have this paper, down the road, you can sell the property, collect notes on the property. I mean, I just love the strategy. And this is what it was. It had little cottages on the property. It had a couple of duplexes on the property. It had fourplexes on the property. It had a 6-unit motel on it that had efficiencies on it. It had a host of everything on it, and I loved it, man. I'm like, Jake, this is nirvana for me. I mean, this is what I was looking for in New York, because they're mixed use and they're non-conforming, but it was right on the main road. They're building a Walmart down the street from it now. The location was fantastic. I knew we needed to reposition the tenants. I knew that we needed to do a lot of deferred maintenance, but it was just us. We didn't syndicate it. It was just me, Jake, and my brother. 10% down, 10% owner financing. So we needed to come up with $60,000 plus closing costs, which was $83,000. We bought the property at $600,000. The note on the property was, I wouldn't say horrific, but at the time it was almost 6% interest, which interest rates at the time were like in the mid fours. It was a 20-year AM. So another golden nugget for everybody out there. Jake and I love community banks, but this 20-year AM stuff has got to go bye-bye. We got pushed on 20-year AMs on our first 2 deals. So another action step, another golden nugget for everybody out there, 25-year AMs, push back. It really helps on your cash flow. And we had 20-year AMs. So we're like, oh, man, you know what? The payment was a little bit higher. We had a 5-year term on this one, which is typical for commercial banks, 5-year term. And after 5 years, we would reset. Push for 7 years. See if they'll give you 7. Some of our community banks are giving us 10 years, but at the very minimum 5, because I don't want to jump off to the next deal. The next deal, we got a 3-year term, which is even worse. We regressed. Instead of learning, we were so desperate.
It was hard to get that one financed.
Yes, it was very well. The first one was a lot easier because the bank, and the reason why we took those terms was the bank held a mortgage on the deal, so they knew how good the property was, so they were willing to take that owner financing component of it. So we were really thrilled about that part. So we need to come up with less money out of pocket. A couple of things that you need to look for when you're looking for, especially for your first deal, but every deal in real estate, the mom and pop. You need to find a motivated seller, and that's what this property had. This property had a motivated seller. Typical characteristics: they were burned out. They had no systems. They had no website. I don't even know if they had a computer. I don't know if they know how to use a computer. They had weekly renters, which was awful. They had no application. They had no systems in place. They wanted to retire. They had health issues. They had everything that a motivated seller has. And, as we started to learn, we were there to solve a problem for them. We were there to take the property away from them and just give them the money. And they took a little note. So they were making $400 or $500 a month every month from that note also. So for them, it was, the classic, win-win situation where they sold the property. They sold it for $600. They did a little bit of roofs for us because we didn't have any kind of construction company. We didn't have a team. That's the other thing. When you're starting to, look at properties in a new market, start to build out a team. Start to get the broker to help you get a property management company, a construction crew, an inspector, a real estate attorney. Get your team before you start really diving into looking at these properties. Because when we took over, it's almost we had our pants down. We didn't have any of these team members. We were stuck, right? We're like, what are we going to do? And fortunately for them, they were actually really nice to sellers. They actually changed a couple of roofs for us. They did a little bit of painting. So that's the story with Courtyard Cottages. It took us 18 months to refinance the property. We refinanced it in December of 2015. And we actually got the interest rate down to 4.25%, 25-year AM. We pulled out $170,000 on that property. So we put in 83. We refied and rolled. That's Jake and Gino's strategy. Refi and roll, velocitize that money. Pulled out 180. And as you can see, the payment actually did stay the same because we got a 25-year AM, we got a lower interest rate, and it was awesome for us because now our income is up, our expenses are down, and this little property keeps chugging along every month between $2,000 and $3,000 a month in monthly draws. And there's your retirement plan. There's your college savings right there because I've got no money in the deal. We have $100,000 extra that we pulled out, and that thing is just, I don't even know how to say it. It's just a
Classic infinite return.
Beautiful little property.
Yeah, a few things. Most important thing, bar none, we got a deal done. It put us in the game. All of a sudden, we're players. I can't stress that enough. Getting your first deal done is just huge. There was a ton of problems on it. It kicked our ass. We figured it out, though, and those learning lessons are invaluable. Every time you get hit in the gut, it hurts, but if you can learn from it, you're going to end up so much better. It's hard to realize that at the time, and I know so many of you listening right now are going through similar struggles like that. Persist, but make sure you put a plan in place and a system in place so that doesn't happen again, or you know how to deal with things when they happen again. I think that's the key takeaway. This was the birth of our credibility book. I remember, sharing it with the bankers at the time. I went in, talked about the business plan with them. That was the birth of the credibility book. It really helped us grow and scale. So I think that's key. If you guys don't have a credibility book out there and you're just getting started, get one. And the other thing was we self-managed. So we weren't, we wanted to learn from the ground up. We didn't ever want someone telling us, no, that you can't do it because of this and not really know. So we learned from the ground up. We self-managed, took a lot of growing pain. So I think those are the key takeaways for me on Courtyard. It was a super valuable experience and wouldn't trade it for the world, but it was very challenging, to say the least.
So Jake, let me give a shout out to a Jake and Gino member, Darren Light. We were on our weekly call a couple of weeks ago, and he said the same thing you said. After his first deal, all of a sudden the skies open up. You start getting opportunities from other people. Property management companies start calling you, real estate brokers start calling you, bankers start calling you, and you're getting other opportunities out there because you're in the game right now and you've got a deal done. So don't underestimate the value of that first deal. I'm not saying to go out there and overpay. You still got to buy right, manage right, finance right. But I will guarantee you, not if, when you get that first deal, you're going to be totally blown away by how many opportunities are going to be coming towards you.
Yep. And then so we're going to go from, that was the February 2013 to the summer of 2013. Our second deal was a 36 unit. We were going head to head with another group, and we're just saying, look, we're going to close. We're not going to jerk you around. We're going to get it done. And that was actually what got that deal done for us. We thought it was I think it was under contract at one point. It fell out. So you got to be just pesky in this business and hang around, because so many times we should not have got the deal, or it wasn't there, and then it came back to us. And that was another example of that. The growing pains with the management company continued. We didn't have a management company. We were using resident managers. And even right up to the closing, and so many of these things, we're going through a closing right now. It was supposed to happen last week. It's going to happen tomorrow. You get right to the last minute and then something pops and you got to figure it out. I got basically a shakedown at a Ruby Tuesdays on a Friday night or a Thursday night, right before the next day we were supposed to close. Gino, I don't even remember what was the guy asking for. I don't even remember.
We had gone over another tip. We had gone over our time for financing.
The bank had pushed us a day over. That's exactly
because we always do deals during holidays. This is during the 4th of July, during Thanksgiving, during Christmas, and we had everything done. The bank didn't have all the financing done, and we didn't have that extra 15 days in there. So this guy actually used it. So the problem with us is we didn't want to walk away from this deal. If we had known negotiation, we would have said, hey, buddy,
23 a door, baby.
Yeah, and so that's the thing. So that's why we didn't want to let this thing go. So Jake is sitting there. I remember he's having a beer and he's calling me up, and I'm sitting outside the restaurant on the bench as I'm trying to coach him through this thing, because when you have that detached, that's what partnerships do. He's in the thick of it. I'm detached. I'm looking at myself logically. What does this guy want? He wanted $7,000. Okay, let's give him the extra $7,000. But then he didn't prorate the rents. So we got
it came down to $2,000 though at the end.
And then by the time that he came down with it was $2,000. He actually had to flew in from California because he wasn't local. So I don't even know why he ended up doing that.
I remember we were sitting in this Ruby Tuesdays is not even there anymore. But I remember when at the time there was like a little bar area with seats, and those families sitting around us, and they were just looking at this guy like he was crazy because he was speaking loud. They could hear what he was saying, and I was just sitting there not giving anything, just listening, just saying no. And then I remember, we went out and spoke. And I think he ended up with like $2,000 or something out of it. But at the end of the day, though, the bridge opened up to the south end of Knoxville. The property's probably worth $45 a door now. We got in at 23. So at the time, you don't want to let the ego get in the way, because that $2,000 was basically meaningless in the big scheme of things. And that's another one of those properties where we took all our money out, we refied and rolled it, and the thing just pays us every month. So
We tried to roll it twice. The property
well, there
was
you
doing,
go. That's nice.
the property was doing well. That was our strategy. The property was doing 10,900 a month in income. We're up to almost 19 grand a month in income right now. That's within 5 years. Had no rubs on it. I remember the one bedrooms were, some of them were renting for 350, 375. We had a resident manager on there who was, we'll refer to him as the devil. He had a 2-bedroom unit. Once we got rid of him, his unit's renting for 700. So the revenue exploded, but we refied it the first time from a community bank back to the community bank. And the second time we did it from community to agency. So that was a real home run for us. We brought our second partner on board for that. I think he saw the strategy, and I remember talking to him. And this is another thing that I learned when you start explaining real estate to people that they don't know in the beginning. I was talking to him about rubs and value adds and this and that, and I don't think he knew the acronyms. He didn't understand. But then once I said, listen, you can bill back the water to 36 tenants and get $30 a month, and that's $1,200 a month, and it clicks, goes off right away. So I was like, wow, we had so many value adds on this property that mom and pop, again, out of town. He probably did not like the manager he had there, like we didn't. So there was so much motivation there. And we bought it right. We bought the property right, and we knew that we were able to increase the income on the property.
So now we're a year into it. We did a 25 unit, we did a 36 unit, and now it's back to February again. We had a deal. We were negotiating in the fall of 2013, and it was on LoopNet. And at the time, it was on LoopNet for what, $6-7 million, 136 units.
I started negotiating August of 2013. It had been on LoopNet for 5 years. It was $6.3 million, 136 units. It was probably worth that if it was repositioned, and it was just sitting there languishing. Our broker, who helped us on our first deal and our second deal, represented us because he knew the seller. So we went in there, and this is for everyone.
LoopNet, but basically off market, right?
Yeah. Another nugget, golden nugget. No offer is too low if it comes with underwriting that makes sense. The property was generating $650,000 a year, mid-50s for 136 units. They were using 5 of the units as storage sheds. The thing was renting. It was just, there was 80%.
There's death spiral going all on at the same time, yeah.
So I told Jake, this thing is worth $4 million. So I'm going to offer $3.7 million, let him laugh at me and see what happens. I offered $3.7 million. 10 minutes later, he went from 6.3 to 4.4. I almost fell off my chair, and I said, Jake, we're buying this thing.
I remember getting the call from the broker. I pull into a pediatrician's office because I was selling vaccines at the time. And I'm sitting there looking at the weeds, right? Because I'm in the parking lot, literally stare at the weeds. And the guy goes, I think he can do like 4.2 or something like that.
I would have taken 4.2, right? And that's the other thing. I knew if we bought this property, it would have changed everything with us, because
this was the game changer for sure.
Yeah, it would have taken us over 200 units. We would have been able to have a couple of leasing agents, a couple of maintenance guys full time. It took from August to like November to get down from 4.4 to 4.075. The broker took a percentage of his money commission as a note. We borrowed money from a partner. We did everything. I think Jake robbed his grandpa.
My grandpa gave me $10,000 on a borrow. This was like the final liquidation for my 401k.
Dude, I blew up.
I had. It was just I needed to get money for this deal.
I blew up my whole life. So my whole life, I actually surrendered one of the policies. Thank God it broke even. But I'm like, dude, I should have borrowed at the time. I just didn't want to continue to make those payments. I blew that up. Two of the best things I ever did in my financial path, which I think most financial advisors would tell you never to do: blow up my 401k and pull money out and stop my whole life. And those two things, I have exponentially exploded my revenue. So just take a look at your own personal situation, see what's going on with you, because there's an opportunity cost to this. Because if I had not bought this deal or one of the next deals we're going to be talking about, I wouldn't be down at this path right now. I'd still have money in those vehicles, but
you'd be in the roller coaster right now.
Yeah, I know, up 1,000, down 1,000. So, I mean, it was an awesome deal for us. And it's
29 a door, 2 and 3 bedrooms, brick, great location, workforce housing. And I think up to this point, we've refied $3 million out of the thing?
1.6 and 2.2. So $3.8 million.
Wow.
And And we went, the first refi took us 18 months. We tried to go to CMBS. They were just very difficult. They were not giving us a very good valuation on it. We ended up going back to our community bank and they refied us out. And last summer, we went to agency with this thing, and agency really hit us up nicely. Now, the thing about this property was $55,000 a month. Jake, as he was leasing these things up, he'd be sending me texts with a cannon exploding because we had to lease up. Remember that? We had to lease up like 30 of these things, and we were leasing up 3 and 4 a month. And there wasn't that much to do. That's the thing, guys. When we go in there, we were doing paint, flooring, and a little bit of touch-ups. So most of the deferred maintenance outside the big CapEx stuff, we utilized some of that refi money to do a lot of the breezeways and a lot of the stuff that we ended up wanting to do. But it was amazing. The property within their first year, about 18 months after, was doing $85,000 a month. They had no rubs, so 136 units, doing $30 a month in rubs. It was amazing what we did. And the funniest thing about this property was it was 2 miles down the road from Denso Manufacturing, which has got 4,500 jobs. So we knew the market, we knew the area.
And everyone makes $12 to $18 an hour.
And the crazy thing was the broker knew that this deal was a home run, and he was convincing us. They were renting out for $450 a month. They wanted 700 credit scores. We went day one, $595 with very, very light value adds, maybe $1,000 or $1,500 per apartment we were doing, because they were actually some of them were in decent shape. Some of them that were down units, we actually had to spend more. But I mean, talk about like walking into like, I don't know, nirvana. But we were fearful. Where are we going to get the money? How are we going to take care of this? Jake is still working full time. How are we going to hire people? It starts turning into a real job once you get over the 100 units, because now you're going to have full time staff, and it was scary for us. But we figured it out.
I remember I was in Florida for a conference like the week after we closed, right, for the vaccine conference.
Mm-hmm.
And I was running back and forth to the bathroom, texting back with the resident manager. Oh, we just got another one at 600. Oh, another one at 650. I didn't want to leave the bathroom just to check all these texts because these people were talking about these vaccines and shit. I could care less about it at the time. I'm just seeing and then I'm sending Gino the cannons. Oh, we got another lease. We got another lease. It was amazing. But realistically, it was $53 a month when we bought it. Things doing about $110,000 a month right now, which is
now.
We put in 600 some odd thousand into the deal at $29K a door, and we've already, as Gino said, refied 3.8 out of it, and it typically pays about $20,000 a month still to this day. So it's just
more importantly, my boy over there cost segregated it, and he just said, let it rain, because I'm leaving my W-2 and getting my tax money back. So that was the golden goose for this thing, right? So our strategy, as you can see, buy from mom and pops, motivated sellers. And when you buy these things, start the cost segregation train, and all of a sudden that was his ticket to get out.
This was the one that got me out. Yeah, this was the one that got me out the next year. It was, I think it was, did I quit in 2015? It was 3 years.
Mm-hmm.
So we got this one. Yeah. So this one, and then all 14, we did the cost seg on it, and then that one. Yeah. And I got a ton of money back.
I personally think you could have left sooner. I just think that you were comfortable getting your job. I think you wanted a little severance package. So everyone out there, there's no rush to quit your job. You quit when you think you're ready. If you have 80% of what you need for your living expenses, I think it's time to pull the trigger. If you're at that point, I did the same thing with leaving the restaurant. I had about 80% of what I needed, and I said, it's time for me to leave, because you'll be surprised what happens when you leave. You'll be able to focus on real estate or whatever venture you want to, and then you'll start making more money that quickly. So, it's hard to just keep holding on. There's going to come a point where you need to leave. So I think Jake found a great balance. He was more than comfortable. He was running day to day with the property management. He's like, okay, I can focus my efforts full time. I've got more than enough money to live in. You're
jumping ahead a little bit. I'm going to hit 2 more really significant milestones here in the journey. So in summer 2014, we added another one very similar to that deal we just bought, but it's 24 units. It just slid right in, no additional staff, economies of scale. That was great. So we stacked on, to the portfolio. And then in that fall of 14, we actually started Rand Management, which is our property management company. And then we started to get serious in scaling that up, because we needed, just a better structure and systems in place. So that started, taking basically a year and a half, almost 2 years, about a year and a half after we actually got into it, we formally started the property management company, which, led to some really great things in the future. And then in 2015, as Gino was saying, after that cost seg check came back, I said sayonara, was fortunate to negotiate a severance package with the company. And this happened, Gino. You forgot to mention this one. Summer of 2015, we actually we got our online game on who started the podcast.
That's right. So let me recap real quick. 25 units, 36 units, 136 units, and 24 units. So you can see the scale and the progression. Then we went back to 24 units. The one learning lesson that I learned about that 24 unit property was we had a broker who she didn't know what she was doing. She was talking about the view and the colors and the paints and the trees. And I remember we almost lost that property because it was $500 worth of broken windows there that they didn't want to fix. They should have. But I said to Jake, Jake, this thing's going to pay us 10 times over. Do you really want to fight about $500 worth of windows? If we were newbies or if we really had stubborn heads, because back at the time, you could have done that 3 or 4 years ago. So you know what? I want it. This is a classic good retrade. But you know what? We just swallowed it. We said, you know what? Let's close anyway. So just take a look at the situation. Take a look at the deal. If there's so much meat on the bone on this deal that you think, one little retrade's not going to hurt you, just do it. Just take it.
It was 32 a door for 2 bedrooms right down the road. It totally made sense. And then in addition to that, when that second deal we did, the 36 units, that's how the guy lost out to us, because he started getting nitpicky with it at the last minute. So that actually, launched us into our second deal. So you just got to be careful with that. Mm-hmm. So we got the podcast going, didn't know what the hell we were doing, got online, just started talking, talking cost seg and talking to brokers and some of these things with the podcast. And now holy shit, is this 16, 17? We're 3.5 years into this thing now. Seems like we just started the damn thing.
Yeah. And the great thing about it is when you start a podcast, you just get to meet great people. You get to talk real estate once a week. Yep. You get to like meet some amazing people. You really keep a pulse on where the market's going. And, I'll give you one tidbit. If you were going to start a podcast out there, focus on what you want your podcast to be about. We chose multifamily as a niche, but more importantly, who are you trying to serve? Were we trying to get accredited investors? Were we trying to scale up our education business? For me, it was more like a mastermind call every week. I mean, because when you can talk to T. Harv Eker and Dean Graziosi and, talk to Jay Abraham, and the list goes on and on, Cameron Herold, David Osborne. I mean, I got Jim Shields. I've got all my buddies on here. And you start talking real estate, Ken McElroy, you got the whole rich dad, poor dad. It's amazing what these people can teach you, and just being around them weekly and holding yourself accountable and having to push yourself because you need to read their books and you need to be able to be prepared for their interviews. So you'd be amazed at what a podcast can do for you. So if you're out there looking to do one, just think about who you want to serve, think about who you want to target, who your persona is, and why you want to do a podcast. Jake and I just wanted to do one because it was something we thought would be a lot of fun. And it is a lot. It is a lot of fun. But at the same time, we didn't have the clarity. We were just out there shooting guns. We were ready, fire, aim guys, right? We still are pretty much ready, fire, aim. Every week is a little bit different, but we just wanted to talk multifamily and learn ourselves. And it's been such a learning lesson. We've met so many vendors on the show. We've grown our team tremendously through the show. So if you're out there and you're looking to do one, just focus on, what you want to get from it.
So here's the big moment. This is when we started to learn systems. This is when we actually hired our future regional manager. 281 unit deal. Numbers didn't look right at the time. Ended up owner financing it. How the hell does that happen, Gino?
So this is February of 2015.
We have 221 units. We're going to 281. We're more than doubling. Okay.
Yes. So this is February of 2015. I'm sitting in Mayapack. My kids are doing some type of clay thing. They're doing some type of arts and crafts. I'm sitting in the basement of this, art council, and I'm thinking to myself, wow, $12.5 million for 281 units. I couldn't even wrap my mind around it. So for everyone out there figuring out how am I going to do it, I didn't know how I was going to do it. Looked at Jake. I said, these guys are super motivated. It's a family. They built all these units. It's about 30 minutes from Knoxville. I don't know how we're going to do this. Let's underwrite the deal at $12.5 million. Let's send them the numbers back to them and let's see what they say. Best thing we ever did, because at $12.5 million, the thing did not work because the way they were running it. It was doing $140,000 in revenue per month. The month we took over, it hit 170. I don't know where that $30,000 came from. I think God rained on me that day. No idea, but $30,000 magically appeared. I don't know what was happening. Not going to cast any aspersions, but whatever. He comes back to us. He goes, how about $11 million, 20% owner financing? And I looked at Jake and I said, that doesn't even make sense, dude. I said, sold. So basically my other partner says he was giving us the keys to the business and we weren't getting any money. And to make matters even more funnier, at closing, we got money back at closing. We didn't put any money into the deal. We got money back. A 5%. This is another key, guys. What is the seller going to do with the money? This gentleman was going to put the money in the bank. He put a couple $1 million into our bank, which made our banker thrilled at 0.8%. So find out what the seller is going to do with the money. We gave him the note at 20%. It was a 5%. So instead of putting the money, he got a 5% interest on us. It was a 5-year term, which we'd gotten a little bit longer, but we refied him out, 18 months later. It was a 30-year AM. For us, it was an absolute home run. Now, the reason why this worked was the bank knew that if Jake and I did not perform, that the seller would just take the property back and he'd continue to run the property. So that was why the bank went to bat for us. I think Jake loved this deal because he met his mentor, I guess, Jim Clayton. Jim Clayton was the bank that financed it. For those of you who don't know who Jim Clayton is, he sold his company to Warren Buffett back in 03 or 04. I mean, guy's a genius. He's just an amazing business person.
$4 billion or something crazy. Yeah.
So we used his bank to finance it. We learned a lot of stuff from Jim. We became more clear on what the mom and pop was. This was every single one of these deals has been mom and pop up to now. So, this is where my limiting beliefs actually got shattered, because I always said, you need money to make money. You do not need money to make money. You need to create value. You need to solve problems. That's what entrepreneurs do. We solve problems to make money. That's all it comes down to. We had no money in this deal. We still have no money in this deal. We've refied out, $3 million from this property. Since then, paid off the seller's note and continue to cash flow this thing like crazy. So there was no money from ours coming into it, but there was a lot of intellectual capital. There was a lot of equity, sweat equity going into this deal. And I mean, it was just an amazing opportunity for us.
So 221 units before we get into it. I'm still running checks to the bank. We didn't even get check scanners at this point. And I'm sitting there with my credibility book trying to impress Jim Clayton about how I'm going to do this, I'm going to do that, I'm going to do everything, right? If this needs to be done, I'll do it. If this needs to be done, I'll do it. You don't got to worry about it. Look at our credibility book. We got a podcast. You should give us the money, right? I'm literally sitting there at Aubrey's in Knoxville with the broker and Jim just trying to – so he loved – it's a hustle, right? But, at the end of the day, he's like, Jake, you can't be doing all this. You need to learn the systems. I'm like, what the hell is he talking about? I called Gino. I'm like, what the hell's a system, right? So he starts. That's when we start to look, basically getting into EOS and these different books on scaling up in the Michael Gerber book. And that really was an inflection point for the business, because we went from, oh, I'm gonna do this, I'm gonna do that, I'm gonna do everything. We're just gonna do everything ourselves. To wow, we went from 221 units to 281. We're up to over 500 units. This is a real business. We got to figure this shit out. So I think from that point, we picked up a 16 unit after that. But there was a huge leap in the market at that point. It was August 2015. We just went over 500 units. Everything seemed to double like overnight. Everyone's looking at Knoxville. They're buying it and things like that. I think our book might have came out, by that point, Wheelbarrow Profits.
October 2015. So
okay, so then later that year. Yeah.
For me, this deal is the inflection point, because I've told the story a couple of times. I know Jake has heard it once or twice. I'm in my shed at the restaurant. I'm putting away tins. I'm putting away the pizza containers. I'm putting away the bags of flour. It's basically $10 an hour work. And I'm sitting on the phone talking with Jake, negotiating an $11 million real estate deal. And I just said to myself, I am worth more than $10 an hour. And that's when I really felt the crush to myself, like I'm really wasting my time here. And I think most people on this podcast probably feel that way, to take that leap of faith. And that's when I decided to myself, I'm out of here. I'm really out of here. I had started life coaching in March of 2015. That's when I really started taking those lessons and working in personal development. And I really think that really helped me get to this deal, because I figured out what my why was. And now I figured out how I'm going to do it. Scale up and take this big property down and get out of the restaurant. And this is where I think everything just became so clear to me. I mean, I was one of those, I have to do this. I'm going to do this. I'm going to do that. And I said, you know what? I don't have to. I'm sitting here doing $10 an hour work and I'm negotiating an $11 million deal. Something's wrong here. So I had to shift. I had to grow. And this, as we grew our portfolio, I became the grow as a person. And that's how you start learning. If you don't get out there and get out of your comfort zone, you're never going to grow. That's what I learned from this property.
Yeah, and then going into fall of 15, we picked up a 16 unit from the guy that sold us the 136 units. Basically, it was fantastic. He didn't want to mess with it. I think he gave it to us like 40 a door, prime location, really nice units. And then from that point, it was going into March, but this deal actually got negotiated in December. It was 156 units in Knoxville, and it was something that somebody had locked up and then retraded on, right? And
Yep.
it always comes down to the holidays, right?
So I'm sitting on the beach in October of 2015 on Crescent Beach, and Jake tells us we lost the deal. I'm like, oh, we lost the deal. So I was a little annoyed. I'm like, you know what? This would have been an awesome deal. Come back, sitting in the library in Thanksgiving week of that year. I get a call from the broker. These guys are going past the due diligence period. It's coming back on the market. So it's one of those things where you need to pick up the phone. Whenever there's a broker calling, you need to. It was the Wednesday before Thanksgiving. He calls me. So I'm like, Jake and I'll have an offer in. We put an offer in. We were still second behind, but everyone wanted to retrade this property. We didn't. We just said, you know what? There's $30,000 worth of stuff on here. We close in February. We get a $50,000 credit because of the cable contract. So there's 50 grand in our pocket, plus another 30 grand that we had negotiated. It was just a home run, plus the prepaid rents. It was just an amazing deal for us. 45,000 a unit. The thing is worth probably in mid 70s right now. But more than that, it was just another awesome deal for us.
So Gino, we got 674 units at this point, and we haven't paid over 45,000 a door.
And we refied some of these deals, and we haven't syndicated a unit yet, right? So should we have syndicated deals? I don't know what the question, what the right answer is. Maybe we'd have 3,000 units by now. But this is all equity for us. This was all our cash flow coming in every month. This is all our principal pay down. We owned everything. If we made a mistake, septic fields go, we have to pay for ourselves. We're not beholden to any investors at this point. So that was our comfort level. So I'm not saying we're right or wrong, but that's just where we were headed. We were headed in that direction.
So we had a little hiatus at this point because the market really started to turn. We're at 674 units, haven't paid over 45. And now we go on almost this just run. It's 16 months. We don't buy a deal. We can't make anything work.
And I think it was better for us because we had the growing pains. So we're actually able to scale the management company. We're actually able to focus on quote unquote those systems. We launched our very first live event. So the Jake and Gino platform is starting to grow. We're starting to get more education going out there. The podcast is growing, but we can't find deals. And one thing I learned is you have to take what the market gives you. We're looking for 8 caps in a 6.5 cap environment. You're not going to buy. So, that was us being stubborn, and we were missing out on deals, and we saw people overpaying. We just didn't want to do that. We knew where we were coming from.
There was one or two that I would have probably liked to get, but I don't know that we really missed out that big because they still paid more than I felt great about.
But I don't think we were ready to buy. I think we still weren't syndicating yet. So we still didn't raise money. We're still using all of our internal capital. So we were comfortable in that aspect. What pushed us to get our next deal was a hurricane. No. You're missing out.
That's right. Well, we had a few things before that one though. Before the hurricane deal, fall of 17, didn't we do the auction one before? Or was it the hurricane?
All the same? So March of 2017, Jake says, you know what? There's a 64 unit deal. It's going on foreclosure. It took us 9 months, and how many trips to the steps of the courthouse for this thing? Guy kept going into bankruptcy for delaying the foreclosure. So we had 2 deals closed in December of 2017. I go down to Knoxville in September of 2017 because it was Hurricane Irma. So I evacuated Florida. That's my luck, guys. My luck is I moved to Florida in July of 2017. 2 months later, I'm evacuating. We had looked at this deal a few months ago. It didn't make sense. I don't know why. We were stubborn because we weren't taking what the market was giving us. We thought it was overpriced. Get that down to Jake, and obviously I'm there for the week. So Jake and I, we have to work. I mean, there's just no 2 ways about it. We're working. We're looking at deals. We drive out this property again, and all of a sudden it's like, let's put an offer on this thing. It had a homeowners association component, which a lot of people were scared off of. It had condominiums. Now we look at it from then, and we're like, I can't believe we missed this thing. I mean, because what an awesome property this thing is. It was 100% occupied. But the thing is, rents were so under market, and it was just amazing. Was not being run efficiently. Another mom and pop, they built the property. These guys, they were construction guys who built it, but they weren't running it properly. The management wasn't being run properly. And we looked at the deal, and we made an offer. And in December of 2017, we ended up closing on this thing. It was amazing. Like I said, if the hurricane didn't happen, and if I didn't evacuate and go up to Jake and spend the week there and drive around and make sense of it, I don't think we would have bought the deal.
Yeah, no doubt. So we picked up a 64 unit at the courthouse steps, and this is, so it was 18 months of nothing. And then all of a sudden it's just like the spigot got turned on. We picked up a 64 unit. It was like 23 a door or something. And then we stepped up and bought an A-class property, 110 units at, what was the average on that one? Like 80, something like
80,000,
that.
yeah, 80,000 unit
Rent,
around.
but the rents are about, 1,000. So it worked. That was the first time we ever went above 45,000 per door buying property, and that thing's been spitting off cash like crazy. So guys, you always got to look at the net effect. It doesn't, we love to see B space, but this property's been fantastic. And then so we're fall of 2017, and then going into the spring of 18, we picked up a nice little 67 unit, kept it in house. Really, really love that little property there. And then so we're up to, I think, 909 units at this point. And this is actually this year, 2018. And we've been teasing this whole syndication idea for so long. And we're just, we're going to do it. We're finally going to do it. We're going to do it. We're going to do it. We're going to, we got to do one. So we have this big investor list that we've been putting out there. We bring out another team member. And Rand Partners is starting to evolve. We ended up finding a Kentucky property. So not only did we do our first syndication, but we did our first syndication out of market this November. It was a pretty wild ride, actually. So
we took that. We went to look at the property in August of this year, of August 2018. We signed at the end of August, and we ended up closing in November. So it was excellent. It was just in our wheelhouse. Think big, start small. It was only 132 units for us. It was a $6 million deal. It was very comfortable for us. We raised $2 million in 2 days. So for us, we had all the foundation laid. Jake and Gino was able for us to get the investor base. We were able to, get the community to help us, raise the money. We got it from a lot of the investors in the platform. So we're ready to go. We had syndication comfortably learned. I learned it through our podcast, believe it or not. I've podcasted so many amazing syndicators on the show that we actually had an understanding of the model. We had a great team around us to help us out. Great syndication attorney, great everything around us. So that really helped us out. And then after that, we're looking at a deal we're going to be closing on December 28th of this year. We're going to close in a couple of days. And the great thing about that, tomorrow, the great thing about that one is it started in April of this year. So guys, there's a recurring theme in everything here. These deals might take a long time. The deals back in 2017, 8-month windows. Make sure you have a pipe drive or some kind of CRM or something just to keep notes, because these deals do come back. Make sure you put your notes on these properties. And this property, same thing. Back in April, we go look at it. We put in an offer. They reject it. He's going to sell to the partners. Comes back 6 months later and says, "Hey, how about that?" We say, "Sure, let's buy it." So, and it's been dragging on, but it's taken a long time.
Just under 25 a door, though, going back to the basics, right, baby?
That's right. Patient, persistent, but willing to walk away. And it's always about the buy right. You can't, you have to buy these properties right, especially in this type of the cycle where we are right now. If you're buying them wrong right now, it might take you years to get it back. Because once it's bought, you can't take away, right?
So I want to touch on the syndication for a minute. Now, I love the equity and the refi roll, but I love the syndication too. It's just I think I'm an equity hound, and that's where I feel most comfortable. But I love the syndication as well. And the syndication is going to enable us to get into, if we have to go and buy a 400 unit at $30 million or whatever the case may be, right? So that's going to add another tool to our toolbox. That's what how I look at the syndication. I think so many guys are concerned with a number. I want to own 200 units. I want to own 300 units. And they get caught up in that. I got to syndicate this so I can get to that point. I would not have changed anything the way we've done it, where we've gone in and we've bought these things, we've refied them, because it's created a tremendous amount of wealth. So on the front end, syndication is great. Refi and roll is great. Partnerships are great. Try to figure out what your goal is and then kind of reverse engineer it, work back to that. I love the way we've done it. I wouldn't have done it any differently because it's created a lot of wealth. And the easy thing for us was we've laid the groundwork. So when it came time to syndicate, the podcast helped grow a large investor list. We learned systems, going back to our fifth deal. So we really understood systems well. Therefore, we brought somebody on to put them in place to help with the investor relations and things like that with the syndication company. We put CrowdStreet in place. So we understood systems. So it was basically like everything was built. And now it's just like, okay, let's put it together. And it was a very easy way to syndicate versus not having any of this stuff done and trying to syndicate from the beginning. So I think for us, syndicating was just sort of a natural, easy progression versus trying to syndicate from the beginning because that groundwork was already laid.
We've got A few questions from community members.
Hold on. You're forgetting though. There's a lot more we can get into, but I'm going to say one more thing. Our team, we have a phenomenal team, and just a big shout out to everybody that's on, the Rand management team. And they pushed us in different directions at times to do things. And this fall, they actually pushed us to get into more of a charitable type structure. So we created something called Rand Cares. And this Thanksgiving, we actually fed over 9,000 kids, partnering with the Second Harvest Food Bank. So, whatever it may be, like a lot of good stuff can come from building these businesses. We have, multiple businesses going on right now under the Jake and Gino brand. But just with all this being said, what started off with a 25-unit complex and no one knew what they were doing, now you go right up the road from this place and over 9,000 kids are being fed because of the work that's been done. So we tried to compact this as much as we could. We could have gone on for days, talking about the trials and tribulations. We tried to wrap it up quick, but a lot of good has come from that 25-unit crack then. Sorry, G-Dad.
That's okay. Mr. Colin S. asks, what are the best ways to overcome the growing pains of 100 to 500 units, assuming self-management?
Systems. I mean, I think that's one thing that we detailed very closely, is that when it was the I'm a mentality, I'm going to do everything myself. You have to pick up the Michael Gerber book, Traction, talking about EOS, Scaling Up. Those are great books. They're going to help you systematize your business, whether if you're just doing a straight syndication company, if you're doing syndication and management, whatever the case may be, you have to learn to systematize and really bring the right folks on board, because that's going to help you propel getting the right folks on your team. I think those are some of the biggest things, because you can try to find ways to bootstrap it and everything in the beginning, but if you don't get serious, you don't get real, put systems in place, when you start to get over 100 units, that's when you're going to flounder and it's going to become really painful. Also, when you get hit in the gut, we talked about this earlier, learn from those mistakes, put systems in place to prevent those things from happening in the future. You got to learn from the pain.
My mistake was hire really slow. Make sure you vet the people you want to hire, but fire really fast. If somebody's a cancer in the organization, I learned this the restaurant.
Get out the scalpel.
And you know what? That's the hardest thing in the world to do, because they have families, because they're feeding them, and you might feel bad for them. And I totally get that. And I've been there, and I'm still there sometimes. But that will affect your business, because that will bring down the morale of everyone else around them.
It's not good for them either. It's just a bad fit all around. The person's going to be better off finding a better fit for them down the road.
So that's the one system you need to do. You need to know how to be able to fire people, because nowadays it's not like it was 20 years ago where you're out. You have to document it. You have to write people up. So make sure you have a system to actually hire them. Make sure they're a right fit for you. Create a mission statement for your company. For Jake and Gino, I want to hire people who are motivated, who are educated, who are, into continuing education, into continuing into personal development, and really want to help people. So if you fit that mold and we're looking to hire somebody, that's what I'm looking for. If I am interviewing somebody who says it's not my job, I'm a 9-to-5 guy, well, guess what? I'm not going to hire you.
Way too much of an entrepreneurial environment for that to be a fit.
Exactly. So just know that that's one of the biggest learning lessons that I had. Let me go to Melissa A's question. At what point in your journey did you realize you could attain 1,000 units?
Probably at like 909 units.
Yeah, when I crossed the threshold.
So we're basically coming up on 1,187 units, most of them, being done in-house, except for the 132 unit syndication. And guys, this is not rocket science. If anyone out there listening that they want to do this, I think it's attainable for them if they are willing to work their asses off. I really think work your ass off, put systems in place, and you're going to be able to do it. Man, I don't know. It was up there. I don't know why, but it may have been, when we were 800 or 900. That I thought it was just something about the 1,000 units, especially since it was basically all done in house, that it seemed like it was still going to take a while. I guess it was even further out there in my mind. I don't know why.
So that's my limiting belief right now. I would rather have 300 or 400 in-house units than have 1,000 syndicated units. That's just me, because I know those 300 units. I'm totally controlling them. I don't have to sell them if I don't want to. I don't have to pay an investor preferred return. That cash flow is coming to me every month. I can enjoy that cash flow every month. So that's for me. So it all depends on your mindset. I wasn't shooting for 1,000 units. I was shooting for a certain dollar per month in cash flow, so I could retire from my job and focus on this full time. So it really comes down to what you think. 1,000, 2,000, 5,000, I don't really care. I don't have an ego about it. So just focus on.
1,000 is nice stuff.
It is nice, but focus on that number that you need to really retire from your job. Everyone's talking about AUM right now, assets under management. Not a big deal. I don't know what our number of assets under management are because it's almost like your net worth. What does net worth mean? Net worth's fallacy. You can't eat net worth, but you can eat cash flow. So just make
And you
the
can't
distinction between those, right? Vince asked the question, if I'm working directly with the listing broker on a deal, how can I trust that they have my best interests in mind since they are essentially representing both the seller and me? He's been getting good of all the information I request, but at the end of the day, his commission is being paid by the seller.
Well, you know, the way I always look at this is that the less people involved, the better, because my message needs to get to whoever the seller is. So if I have to, you know, hop over 3 or 4 lily pads before my message gets to that seller, then there's going to be problems because it's going to get distorted and they're not going to know what I'm really trying to communicate. So I think as closely as I can get to the seller as possible. So if that means there's one broker in the middle, that's better than 2, 3, or, you know, an additional attorney. So they may not have your best interest at heart, but what I find is that they have their best interest at heart. So what they're trying to do is get the deal done at the end of the day. So yes, they may be, you know, trying to represent the seller or this, that, or the other thing, but ultimately they're going to want to get the deal done. And if it's being sold for 7 million or 7.1 million, most of the time those guys just want to get it done. So I'm really not that concerned with it. I'm just concerned about whatever I'm trying to communicate is getting it across clearly and not distorted by 15 people's perception of what I'm trying to say. So I'm not that worried about that.
Yeah, just remember the listing broker is working for the seller. So you don't disclose anything that you don't want the seller to find out because he's got a fiduciary responsibility to the seller. So Jake and I love to work with brokers. We love to work with whoever's got the listing broker. We'd rather go right directly to the seller. The 281 units, the broker, it was sort of representing him. I mean, it was his listing, but we were really good friends with the broker. We went directly to the seller and had communications with the listing broker and with the seller. That's what made this thing really happen and really work. And don't be confrontational about it. You know, like I said, I put a $12.6 million offer. You know, we showed him our underwriting. It didn't work. He came back to us first. So you don't have to make me confrontational. One more question. Aaron N asks, you moved on to syndicating larger deals. A lot of new multifamily investors struggle with the choice. Do I go big and syndicate my first deal, or should I JV with a like-minded investor to gain experience, maintain more control of the deal, and leverage the refi and roll strategy to build my portfolio? What are the pros and cons of each route?
We didn't move on to syndicating larger multifamily deals. You know, the largest deal that we've done is 281 units, and that was an in-house deal. So I think we just want to be clear about that, is that with the refi and roll, you can build up nice, you know, piles of cash in order to repurpose into, you know, future properties that, you know, roll it into the next deal. So the syndication is nice because it does allow, you know, a business to take down like a $30-40 million deal like we were talking about. But, you know, like I said, I'm really an equity hound. I like both. I think it just depends on the deal, and it's having multiple tools in your toolbox so that whatever is the best fit for this one, we're doing a deal tomorrow. We're doing it in-house. It's a community bank on the front end. It's distressed. It's 25 units. You know, that's an easy one for us to just scoop up. The next deal comes along. It's a $10 million deal. That's probably a syndication deal. So I think it just depends, and you want to have that flexibility. So again, I'm going to say this one more time. I love the equity. I love having a lot of equity in these deals. Personally, it's a personal preference. I don't think people should shy away from going out and buying a 20, 30, 40 unit deal. There's going to be tax benefits to that. It's going to cash flow nicely, you know, mostly to you. So that's okay. Or if you want to go out and you're all up with the numbers and you want to be, I own 500 units guy and taking over the world, go syndicate then. It's what's important to you. But if it's a net effect, don't shy away from some of the smaller deals because they can make you a lot of money.
I think syndication is a great tool in the toolbox.
Yep.
That's what you have to look at it as. Each strategy works at certain levels. If you're just starting out and you want to, you know, start learning how to syndicate a deal, find someone who's syndicating a deal and see if you can raise money for their deal. That's probably one of the best ways, low value ways. Find a sponsor who you really like. Let's say you like Jake and Gino. We're not doing this, but let's say, for instance, there's a Jake and Gino out there that you really like, you're really following, and they're a syndicator. Approach them and say, hey, can I raise some money for your deal? Maybe they'll let you raise money for your deal. If not, hey, if you have some money, why don't you become a limited partner on their deal and learn the ropes from their deal? You'll be making 5, 6, 7% hopefully on your money, and you'll also be learning their strategy, learning their processes, learning how they do webinars, learning how they send out emails, learning how they raise money, learning how they, you know, analyze a deal, learning how they choose a market. All this stuff you can learn as a limited partner. So that's what we're doing on our deals. Our investors that come on board, we do monthly webinars with them right now. So that's one of the perks of investing with us. You want to learn the market, you want to learn the deal, you want to learn what's going on in our property. That's one of the things that we're doing with our syndication deal. So So many different ways. I just want people to get into their first deal, whatever
Yep.
you need to do, whether it's a 4-unit or a 40-unit, doesn't matter the size. Think big, start small, but just get into that first deal, because then everything's going to change from there.
Amen, brother.
I have no other questions, Jake. I want to start out the podcast by saying I just wanted to thank everyone, that sits down, listens to us talk about real estate. It really means a lot to us, and that we can share all this information with you guys. My motivation more than anything else is just to let you all know that Jake and I are just two regular guys with families. We just have been able to focus on stuff. I want everyone to walk away from the podcast and just sit down after you're done with the podcast. This is our action step that I want you to do. I want you to get clarity for 2019 and beyond, and ask the question, what is important for you? I can answer the question to myself, and that question changes all the time. Back in 2015, it was totally financial freedom. It was totally selfish, because if I couldn't become financially free, I wasn't able to help other people. I wasn't able to get on a podcast with Bob Berg and really listen to his message about creating value. So get off the podcast. What is important for you? Become clear, get clarity in your life. And that question needs to be asked every 3 to 6 months, because that's going to change constantly. What's clear to me now, what's important to me now is spending time with my family, but also helping people get their first deal. That's what's really important to me now. Growing the portfolio is also important for me now. Continuing to educate myself. You like that, Jake?
Educated, baby.
That's what I'm saying. It's not rocket science, guys. You know what I'm saying? So just think about that. What's important to you? And that's subconsciously, I think Jake and I, that's why we were so successful, is we're not smart, but we're hard workers. And this is not an easy way to wealth. Nothing is an easy way to wealth. It's a hard way to wealth. And that's one of our big things, Jake and I. We're really hard workers. We're willing to work. That's one thing the restaurant taught me, is there's hard work. The trinity is work hard, work smart, and then ultimately you're going to work passionately. That's what the two of us are doing right now. But there's a lot of work on the front end. And then all of a sudden, those systems come in place. You're starting to work smart. You got those two right there. That's going to lead to financial freedom. The third one, work with passion. That means you're going to have a fulfilling life. So that's what I want everyone on this call to start doing. Follow that trinity. And I know you're going to have a kick-ass life like we do.
And I think my last point is follow the framework. If you guys haven't read Wheelbarrow Profits yet, it's all about the framework: buy right, manage right, and finance right. This is a 3-legged stool. You guys want to, take the next step with us, jump online, apply to work with us, jakeandgino.com. We have great coaches there, willing to help folks and take you through the process. Gino, that's all I have. I think it's been a very, informative show, and I really appreciate you.
Mr. Stenziano, one last thing. If you guys like the show, just leave a review on iTunes. Send me a screen grab at jakeandgino.com. I'll send you a PDF copy of our book, Wheelbarrow Profits, because Jake has been talking about the 3-legged framework. It's an easy book to read. Buy right, manage right, finance right, but it's all about shifting your paradigm. It's all about shifting your mindset. I want you to read this first book, because we're coming out with another book in 6 months.
Oh, shit.
And this second book, that's what partner's all about, pushing me out of my comfort zone, bro. Got to write another book. We're writing another book. It's going to be really awesome. So leave us a review on iTunes if you like the show. Only if you like the show. Only if you've added a ton of value to your life. I will send you out the book, PDF copy, Gino at jakeandgino.com. Mr. Stenziano, this has been awesome. We can keep talking, going on and on. Just want to thank everybody out there for listening, and let's make 2019 even better than 2018.
Awesome, man. Thank you.